All right, welcome everyone to another Storage Authority webinar. I'll be your host, Garrett Bird, here along with Josh Parker.
Good morning.
Today we're talking about something every business owner should know: tax breaks. The tax code offers huge incentives business owners business owners, especially real estate owners, real estate developers. And here's the bottom line. Tax laws allow for significant expenses and deductions. So that means you can reduce your taxable income and pay less taxes. But it gets even better. Some taxes can be completely eliminated when you take advantage of the right strategies. Now, most of these opportunities don't apply to W-2 employees, which is why many new business owners never hear about them. So that's why I'm excited about today's conversation. We're going to dive into tax strategies for self-storage and exactly how much you can save. And with us today, we got Marc Goodin, CEO of Storage Authority Franchising. And happy to bring on our special guest, Heidi Henderson from Engineer Tax Services. All right, let's get rolling here. So we'll jump right into the first question to you, Marc. Marc, you've been an expert in self-storage for 40 years. You own multiple facilities. But let me ask you, does that allow you to make does that make you a self-storage tax expert?
Garrett, great to be on board today. I'm happy you're putting this presentation together, and thanks for having us on. But first, I'm excited to share some tax strategies. No, I'm not a tax expert by the tax code, or I'm sure there's actually tax code groups that say you have to have this degree and that degree to be a tax expert. What I'm going to talk about is things that I've implemented in my life, and a couple of things that I have not implemented, so that you can go ahead and look at these things in further detail and implement them. None of the things we're going to give you here today that you should just go out and do. Before you do any tax strategy, you need to ask yourself, what do I need to do to really make that legal? What do I need to do to the pros and cons of that? And how does it affect me? So you've got to work with your tax advisor and your tax group. It might be one person or two or three people, depending on which tax savings you can take advantage of. A couple of things I won't be discussing today is inheritance tax and trust savings. That's another level where you've got to start that with an expert, and there's just so many changes and so many options there. But we're going to hit a lot of the first level basics and even a lot of the second level basics where you can literally save hundreds of thousands of dollars.
All right, so we'll get into question two right to you, Marc. So a lot of people here do have CPAs who handle their taxes. So why do we need to know these tax strategies ourselves?
Well, first of all, I highly recommend everyone use a CPA to do their taxes. If you do your own taxes, you are going to miss some things. You are going to make some mistakes if you try to implement some of these things. And some of them are clear that you and your CPA can't do on your own. You might need an attorney, or you might need somebody like Heidi who knows the certain depreciation laws and what needs to be done and calculated by who to make them work. I have 3 CPAs right now, and I've had several over the years, and not a single one of them has ever said to me, "Hey, Marc, let's sit down and strategize on how to save taxes." Not once. I mean, their job really is bookkeeping and filing your taxes. Their job is not tax strategy. When you see some of these tax strategists say CPI stands for copy, paste, and attach. Well, that's not a negative thing. That is their job. I love my CPAs. But when it comes to tax strategy, I hand it to them in the form that they can double check it, make sure it's right. And without that, it's just not going to happen with your CPA. So just ask yourself, how many times has your CPA said, "Hey, I got some tax savings ideas for you this year"? They generally don't, unless they are a true tax strategist. And so one of the things we're going to talk about is you always have to do your own independent research. And today it's so easy to start that research with Chat GPT. You can't trust the computer, but it can give you enough basics. So if your CPA or your tax strategist might be missing something, it'll give you a pile of questions to ask these guys about something, a strategy that we're talking about today, or one that you might have heard of. So you don't, when you go to spend your time with your attorney at $400 an hour, you've got some basics before you go with them.
All right. So can you share some basic tax strategies for the listeners, without needing to hire a tax strategist?
Yeah, I have 5 simple tax strategies that everybody can use. You really don't need a tax strategist to use them. But first, I want to say for the novices, and you're a pro, you're going to laugh at this, but I hear this once a year as we help people get into businesses. And so I want to remind everybody, leaving money in your company is not a tax strategy. You make a profit, and you say, hey, I want to leave that money in my company bank account because next year I'm going to need that money for this project that I've got. I got a $100,000 project, so I need that money next year. It does not matter if you leave the money or take it out. If at the end of the year your corporation, your company made a profit, you've got to pay taxes on that. So just remember that if you're brand new, and because I see people getting surprised that you've got to pay that. You know, Along with that, often, sometimes in the very beginning, you've got to bite the bullet and pay taxes, let's say on 50 grand. So your company has 50 grand in it when we transfer to the new year, so you can pay your bills and do things. Otherwise, you could take that 50,000 of profit out, but you might be putting it back in. So you can take it out, but nobody likes to put it back in out of their personal funds. Some people take it out and put it in a special account so they can put it back in. Some people get a letter of credit to cover those expenses if they take all the profits out. But I bite the bullet one time, get 50,000 in my company. I never have to worry again. The next year I'm taking the money out, all the profit out, but it still has 50,000 in case of a emergency. So just something, but getting back to the low hanging fruit, I see a lot of tax strategists on the internet. Here's 10 things you can do to save $100,000. You've got to be real careful. One of my favorites is, go out and buy yourself a $80,000 car. That absolutely makes no sense for a ton of people. I've got a friend that has a demolition business, and he's driving from site to site to site, and he literally buys $100,000 trucks, 2 or 3 at a time, and then 3 years later he sells them to family members and buys new trucks. It makes sense for him. But in the self-storage business, if you're not using that vehicle for work, it doesn't make sense to go out and buy it as a tax strategy. So let me quickly go through 5 quick ideas. One is, I call it the October strategy. And the reason I call it the October strategy, it doesn't work too well in November and December. And that is shifting income and/or expenses from one year to another year. So in December, I'll give you an example. Right now, Josh knows that one of my facilities, the gate was hit by a car. The insurance company paid me the $10,000 to fix it. It still works, so I didn't fix it yet. But now I can decide, does it look like I'm going to have too much income or not enough income? So I can decide whether to repair that fence this year or next year. If I repair it, whatever year I repair it in, that's the expense that it's going to fall in. And I do that with a pile of different things. I do that with, even supplies. I'll ask my staff, okay, what do we need for the next 6 months of supplies? Boxes, computers, blah, and I'll decide, does it go in this year or next year? So that's a pretty simple one. Even income in my engineering company, if I knew I was putting out a proposal the last week of the last week of the year, and I know the guy would come in and give me that check immediately, I might not hand him that proposal to the next year because I don't want that income shown this year. So there's a lot of things there that you can do. Another one is called the Augusta rule, and that was made up a long time ago and related to, just not enough housing at the Augusta Open, the golf open. So you can literally rent your house to your company for 14 days. And then that money comes out of your company, it goes to you tax free. So literally, you can rent your house out for 14 days. But there's a bunch of rules. You can go to ChatGPT and say, what are all the rules if I want to, implement the Augusta rule? And it will tell you. You go 15 days, then you got to pay taxes on all that money you made. It's exactly 14 or less. It's got to be property that you own, a resident that you own. And ChatGPT will ask, hey, do you want me to put together all the forms you need? Because you're going to have to determine what the value of your house would be for rental. In my case, it will be about $1,500 a day because I live out on an island and there's two or three fancy hotels. If I get a quote for them to rent a conference room for a day, it's going to be $1,500. So I get $1,500 times 14 days. Now you've got to actually record that you've used your home for it. Now that's easy for me in this case because Garrett and I live in Florida, but it's not the same as being together. So, Garrett might wonder, why does he come to my house once a month? And I write it down. Once a month, Garrett came to my house and we use the house that's when we planned this, we did some marketing. So you gotta record the information appropriately. But this one is a real good one for ChatGPT. It'll make the forms and everything that you need. Now you might decide, that's a lot of work. As you get older and as you make more money, you got to look at all these tax breaks and decide, is it worth my time to implement these? And in my case, a lot of times it's no longer worth the time, even though it was once upon a time. You can employ your kids, and pay no taxes. And, that's a great way, employ your kids and then put it into a Roth, and, they're multimillionaires if you do that. Now, I'm old generation. My kids came to work for free. But that's a good one to put in there. My daughter, they came when they were 8 years old, so long before they could do it. But by the time they got teenagers, my daughter would work in that office by herself and rent units and love it. Just the interactions and challenges, So I like this one for a lot of reasons other than saving taxes. My son, Lee, hated going to work in the office, sitting there doing nothing. He just sat like bumping along until I said, hey, the manager can't make it tomorrow. I know you got school all day. You want to work in the self-storage? Absolutely. He was there. So employ your kids. That might make some sense. But again, go to ChatGPT and say, I want to employ my kids in my business. How does it work? What needs to be done? What forms do I have to give my accountant? You've got that package together. Before you do it, give it to your accountant. Say, this is what I'm going to give you to do my kids. Is this correct? Um, uh, you know, I get the internet at my cottage. We had some internet there, but I couldn't get on a Zoom or talk to people on the weekend. So self-storage pays for my internet at the college. It's like a lot of write-offs. You can have a home office write-off. There's a whole bunch of rules, but that's one you got to ask ChatGPT. If I have that, is that one of the tax savings that increases? I might be audited. What forms do I need? I don't do the home write-off because I got too many homes and it get complicated, and I don't really have a home office. But I do write off everything. I write off my computer. I write off that I have at home, my printer, my paper, and all that stuff. And it's stress-free. I could tell you story after story. 2 years ago, I do most of my work out on the porch. And 2 years ago, I left my, $3,000 Apple computer on the porch overnight, and it rained and it poured. My wife was so mad the next day. But you know what? I just bought another one. The company bought it and gave it to me. to use. So, there's that kind of, even my cell phone. So there's a lot of basic things that your company requires that you have be on call 24/7. Your phone can be a write-off. Again, check on ChatGPT, pros and cons, what you need to give to your attorney. So those are 5 simple ones. There's probably a dozen more like that, but they take time and energy to implement. It's good money, several $1,000s of write-offs, but it's nothing compared to the major tax strategies.
Nice tips there, Mark. But let me ask you this: what's the number one self-storage tax savings?
Well, there's actually 2 major tax strategies, and either one of them can be number one depending on your income, where you are with your business. But right off the bat, the number one I would say is depreciation strategies. Typically you depreciate your business over 39 years. So whatever can be depreciated, you divide it by 39 years, and then you can write that off every year against your self-storage income or your regular income. But what really always excited me is the tax laws allow certain items to be depreciated much faster than 39 years. And you've probably heard about it. There's a couple of major ones. It's called first year bonus depreciation and component depreciation. And those, you just can't go out and do it your own. And actually your CPA can't do it with you. You need an expert. And Heidi is an expert on that. So I want to ask her, a little bit, explain what first year bonus depreciation is, what component depreciation is, what we have to do to implement that in our tax strategy. So I'll pass it off to Heidi.
Absolutely. Thank you, Mark. It's a great segue. So I'm Heidi. I'm with Engineered Tax Services, and we are a specialty tax firm. So, before I dive into component depreciation and bonus and really how the accelerated depreciation works, I want to comment on your remarks about CPAs. And it's so fascinating as I shifted from accounting into consulting. I've been with this company for over 15 years now, and we specialize in tax incentives and things like looking at component depreciation. People don't realize that there are such companies, something called specialty tax. So I always compare it to the medical space. It's like we're the orthopedic surgeon, and you need that strategy and that technical expertise that couples then with what your CPA will do, which is the compliance and filling out the forms and making sure that everything's accurate with your accounting. But those complex strategies, the incentives, the write-offs, and some of these more technical things do require a different level of expertise. And so when we have clients often very frustrated with their CPAs for maybe missing an opportunity like this, we're doing a lot of education to explain why there is a big difference between what your CPA is doing and then what you can do when you understand the complexities and what's available for real estate owners. So talking specifically about depreciation, self-storage is one of the absolute number one best property classes to invest in for the tax benefits. I talk with investors all over the country all day long, every day. They are asking me, what are some of the best property types I can buy? It is pretty much always self-storage. And now with Trump's new One Big Beautiful bill that he just passed, you probably all have heard that we now have 100% bonus depreciation back. And there is, I hear a lot of confusion about how does bonus apply? Does bonus mean that then I just bought a property and I can just deduct my whole property? Not exactly. So then people think, well, cost segregation is bonus. So then when bonus was phasing out, cost segregation doesn't make sense. And that also doesn't tie. So let me explain to you kind of the differences and how they work hand in hand, specifically as it relates to self-storage. So the IRS allows for us to depreciate the asset, the value of our assets, real estate. So you buy a building or you construct a building, the cost of your building or your improvements are then over time, 39 years is the timeline the IRS has defined. I don't know, it's 75 years ago. So we write off the value of that building over 39 years. That is your standard deduction. If you have a $5 million building, it's that divided by 39 years, and you take the standard deduction. What is happening when we look at component depreciation or cost segregation is it is talking about itemized deductions, like Mark was just talking about, how we can claim other deductions for deducting our home office, or deducting costs for renting out our home, or other things we have or vehicles. Those are allowable when you itemize your deductions. So what's interesting is the IRS allows you to itemize deductions for your real estate as well. So if you build or you buy a building and you take a standard deduction over 39 years, think about it if you have a tenant unit, like if there's a property or an apartment there that a property manager is in. If there's carpet in there, do you expect that carpet will last for 39 years? I mean, if it does, that would probably be gross. We would hope not. We would hope you would replace it within that, shorter period of time. So that's just one little example. But when we look at cabinetry, we look at the partitions in your units, we look at the building types, we look at asphalt, fencing, security systems, the gate on the front of the property. We look at many of these components, and if we can segregate those out and define the value or cost of each of those little teeny pieces of your property, the IRS says, look, if you want to itemize the deductions, we'll allow you to do that. But you have to do some type of a study or analysis and prove to us what the cost is for each of those items. That's what a cost segregation study is doing. So we're then doing this analysis or an appraisal to segregate out each of those components. Then that you have to have that data set in order to claim bonus depreciation. And bonus right now at 100% has been made permanent. And what bonus is any asset with a useful life shorter than 20 years, you can take 100% deduction the year you buy it. Whole complete write-off the whole value of it. So when we're looking at a self-storage property and your CPA says, okay, your 5 million divided by 39 years is your standard deduction, that's all you get. But when we itemize, let's just say that we pull 30% of that out. Let's say it's a $5 million cost. We pull out 30% and say, look, 30% of this is personal property, land improvements, security, partitions between my units. I have all these other things. And let's say that's $1.5 million of your cost. Now with bonus depreciation, what happens is we extrapolate those items, we categorize them into different tax categories for your CPA. When that's done, the result is, oh, these have a useful life shorter than 20 years. Guess what? They qualify for bonus depreciation. So if we shift $1.5 million out, we identify those as alternative or personal property assets, you take bonus a full deduction. So again, a $5 million property, it could be a $1.5 million deduction immediately in the year that you buy the property. So that's pretty significant when you consider without that type of a study, I'm doing the math here, at 5 million over 39 years, you would take a $128,000 deduction. So the deduction, again, $128,000, that's standard deduction for a $5 million property. Again, when we're looking at cost segregation, it could be 1.5 million in the first year. So it's a massive offset to any income being generated on this property, maybe other properties that you own as well. And then it depends on your tax situation, could potentially be other income, including W-2 income, depending on how active you are in your investments.
That's awesome, Heidi. You can lose a lot of money if you and your accountant could try to do it. And in fact, it could be illegal because you have to have an expert determine all those costs. And I want to give a couple of examples. Let's say you just developed a self-storage and the total project was $9 million. You can't write off that $9 million because you can't write off your design. You can't write off the design, the cost of the property. So what we're writing off is the construction, and so you want to contact Heidi, the day construction starts, or even sooner, so she can help you get some numbers from your get some numbers from your contractor. Some things that way it's really accurate. Her expert does it. You have backup from the contractor. You go out there and you fill in a hole with dirt, you can't write that off. But if you go in and you're putting down pavement, you can write off the pavement. You can also write under the support of that pavement because it's connected to it. So earthwork, a lot of times you can't write off. But you know what? If you're building a detention pond, removing that earthwork, you can write that off because you're supporting it with topsoil. You're supporting it with things that you need for that basin. It has maintenance to it. So your CPA is not going to need not understand what you can and can't write off. So it is critical. Now, Heidi, you said it was first year depreciation is 100%. I've been in this business long. You've been in this business long. That seems to change every year. In tax Trump law, is it 100% this year and 100% for as long as we go, or what does it say in the current tax law? Because I never say it's 100%. I say we got to check with the accountant because every single year it seems to change.
Yeah. So bonus depreciation in its current form was originally passed in Trump's first tax bill in 2017, the Tax Cuts and Jobs Act. And at the time, we had about 4 years at 100% bonus depreciation, and then it started to phase out. 100%, then it went to 80, 60, and 2025 dropped to 40%. The One Big Beautiful Bill now extended back to 100% for 2025 and going forward. And in the initial bill, it was for 5 years. So for the next 5 years, it would be 100%. What's interesting is the House passed that. Then when it went to Senate actually changed it. And the current tax bill right now says that 100% bonus is permanent. So that's pretty wild because until there is a new tax bill, maybe, in the next election, if someone decides to write a new tax bill and change it, they may. But as it stands right now, it is a permanent 100% bonus deduction for personal property assets acquired.
Yeah. And so I've been in this business for, I don't know, 20, 30, 40 years. I've never seen where we had 100% permanent. So no. All of a sudden, and I've been talking to some people, things are picking up. People are learning this. And, one more thing, Heidi, if you could just help me out understand is, we get $1.3 million depreciation bonus. Say I can't use all that this year. I can bring that forward to next year and the year after till it's used up. Is that correct?
Absolutely. Yep, absolutely. So that's one of the beautiful things about bonus depreciation, unlike some other deductions. There is no limit to the loss that you can generate and then the carry forward period. So in that scenario that I gave of the $5 million property, let's say we have a $1.5 million deduction. A lot of people don't have $1.5 million of income on their tax return. So what in theory that will do is drop your income to zero. And then let's just say your income's $500,000. If your income's $500,000, you have $1.5 million of deductions. It's going to drop your income to zero. You'll have a net operating loss of $1 million that rolls over to the next tax year. And then we'll offset your income for the next tax year. So again, let's say you have $500,000 of income next year. That $1 million is going to apply against that. And let's just assume you don't even have any additional deductions. You would have then zero income again. And now $500,000 rolls to the third year. So it's just going to continue carrying over. So essentially, real estate is the only way to invest and have types of tax benefits and write-offs that can be generated. Also because, I'll give you one interesting case scenario. One of the gentlemen on my team yesterday sent me an email, and he said, "Hey, I'm looking at this project for a client. It's going to generate a significant loss and a very, very large amount of depreciation." And the CPA came back and said, "No, they can't use that. They make too much money." And because they make too much money, their income is over $1 million a year personally. The CPA said they have a limitation where they can't offset all of that income because they're high income earners. They're limited and can't use it. And I said, no, that's incorrect. So that's a misunderstanding that they're thinking about business income and not about real estate deductions. There are no limits to real estate deductions. If you are materially participating, if you are involved in the management of your property, then it becomes active, and there are no limitations to how much income you can offset, which means you can offset 100% of your income. And in theory, 100% of the income tax you pay. So this is how investors recoup those costs, roll that money. Okay. If you pay $200,000 a year in taxes, imagine if you have $200,000 a year, you put as a down payment for a property, or you expand your property and put in some new units. That's equity you continue to roll and increase depreciation again. This is really how we see investors grow their portfolios and truly build something significant.
Exactly. You know, you take the money that you might, you know, maybe you make 100,000, your wife makes 100,000, there's 200,000 in W-2 income. You know, you can look back what you paid in taxes next year, you know, you'll pay no taxes. So you take that money, and if you're losing money because you just built or bought a self-storage, just opened yesterday, the first several months, you're going to lose money. You know, you can take that money and help pay for that. But as time goes forward, it's incredible because your goal is to own a self-storage where you're making $500,000 in profit. And so you've got that depreciation, and you use that, and you know that's why people reinvest their profits in a second self-storage or even a third self-storage like I've done, because it's just, you know, I've saved millions in taxes and use that savings to build wealth. All right, that's awesome, Heidi. Unless you're gonna build your property and then sell it immediately, you want to call Heidi. You know, Garrett, Josh, we all have her contact information. Our emails are just our first name @Storage Authority. So if you want our information, but if you're in the process of searching for a property that you're going to buy an existing one, or you're actually building a self-storage, now's the time. One last tip: if you open or buy in December, you get the full depreciation for that year. If you wait till January, well, then you miss that year. You know, so it's a calendar year. So, you know, I hate to get your CO on January 3rd. You know, if you can get it in this calendar year, it's much better than waiting to next calendar year. It's just a quick tip.
Nice. And I did, for all of our listeners, I put Heidi's information in the chat, so you have it there as well. Another question for you. No problem. Another question for you, Mark. How about a second major tax strategy? Heidi just shared some good ones there. Do you have another good one?
I have another great one, and the reason I love this is even the tax strategists miss this one most of the times. And it's a two-part answer. And here's the first part is keep your job for 5 years after you buy a self-storage or build a self-storage, so you can take advantages of all those write-offs immediately, put more money into your business, build a second business. You know, it's just going to be so valuable. What we have, the second part of this strategy is how the wealthy really become and stay wealthy, and they take advantage of liquidating debt. That's a strange term that the accountants and strategists use, but it's a secret, you know, for the wealthy, you know, because the loan that we have 10 years ago, and it's the same loan this year. It never goes down in value because we always make sure it stays there. We're paying it with old dollars that are worthless compared to 10 years ago. So it's self-liquidating because the tenants pay for it. Every year the tenants pay us more. Our mortgage doesn't get to be more, but that mortgage has less value to it. It's complicated, but we're paying our mortgage off with inflated dollars. You know, if you had a mortgage of $2 million 50 years ago, that would be a mortgage of 100,000 today. I mean, 100, million or whatever we're doing, but it would be 10 times more than it was 30 or 40 years ago. So we're paying it back with dollars that are worth a lot less money. So simply put, the number one strategy of the wealthy is to buy, borrow, and die. You don't ever sell it. You buy, borrow, and die. When you borrow money for your self-storage, it's tax-free. I've put millions in from this strategy alone, millions in my pocket from borrowing from the bank, and the tenants always pay that money back. And I know a lot of people that have sold a self-storage and made $5 or $6 million in a year or two after they've opened it. Some of our franchisees, as a matter of fact. 5 years later, they're always upset with themselves. They could have taken that money out, and now they'd have that asset that it continues to grow. But they sold it because they saw that one-time $5 million profit, 2 years in the business, 3 years in the business. But the tax code pays us to borrow money, and those proceeds are tax-free. So that's actually the largest tax strategy, in combined with the depreciation that people just don't think about. And that's another reason self-storage is so valuable.
What is it? BBD, Mark? Buy, borrow, die? That's the
Buy, borrow, and die. There's so many advantages to that. It really is. And you pay back the loan with inflated dollars, and you can't beat it.
Yeah.
I'm never going to sell my self-storages. At some point it's going to be where I'm not old enough or I'm not young enough to manage it. My kids will be managing it. Right now, Josh manages 2 of my self-storages for me. And you'll see another advantages of that. So, at some point you want to go to, from active management to passive management, and we'll get to that soon.
Another question, Mark, that we get a lot of this from our franchise owners, asking about entity structure. Is there a tax advantage to choosing LLC, S Corp, C Corp, for self-storage business?
Yes, but it depends on your certain circumstances. There's a reason when you only want an LLC, and that's a company. It's not a corporation. There's times you want an S corp, and there's times you want a C corp. And then there's also time you want an S corp and an LLC corp. So let me quickly explain that. Most people start out with an LLC. It's limited liability, and that's the reason that they have it. And it also allows a lot of tax advantages. They don't start out as a C corp. C corp actually the corporation gets taxed. So, often we don't do a C corp unless we're using retirement funds. And when you're using retirement funds, you can do an LLC or a C corp. You got to get to another expert that can do that for you. You can't do that on your own. You have to have an expert. The government's going to make you do that, and you get to choose between an LLC and a C corp. And I believe one of the differences, if you're 50 years old and you're not going to take any money out until you retire, you could leave it in an LLC and not pay some of those taxes. But if you want to take a salary, you got to go to that C corp. But anyways, LLC, most companies start out as an LLC. And an S corp is an LLC that simply elects to be taxed as an S corp. So there's tax advantages for that reason. when you're an LLC, one of the worst taxes, you take your money out, let's say as dividends. We call them dividends. It's just money. It's not dividends like a stock company, really, but we call them that. And we just take out money when there's money available from them. But part of the problem is when you go to do your taxes, you got to pay 15.3% self-employment tax. So, if you're making $500,000 at 15% self-employment tax, that's a big chunk of money. You can figure it out. Josh, you figure it out while I'm talking. But you could save that money by being an S corp. And what an S corp allows you to do is eliminate a lot of that 15% self-employment tax. So what happens with an S corp? You've got to take a W-2 salary to run the company, whatever it takes, what is fair. You can't make up a number and say it's only 10,000. So let's say, to have a manager run your self-storage is $50,000. So you take $50,000 as a W-2 and you pay unemployment tax at 15% on your W-2. But for the balance of that 500,000, 450,000, let's say, you don't have to pay that unemployment tax. So you pay unemployment tax 15% on 50,000 and 450 goes free. So you can see right now that's a decision, because if you're only making $40,000 profit or losing money in your first or second year, you don't need to choose to be an S corp. You only need to choose to be an S corp when you're making enough money that those combinations make you money by reducing that unemployment payment. So, it's not something that first year operator or first year owner of a self-storage has to worry about. But eventually you're going to make enough money that you may want to do that. So that's it. When you go to an S corp, it can be prudent to have two LLCs, one for the land and one for the operations. So that way, that 15% can be divided properly, but that's something you can talk over with your CPA. So there is advantages. You've just got to take the time to learn them. And we're gonna soon here, we're gonna wrap things up, but we're also gonna look at a couple last strategies that you can only take if you're an S corp or an LLC, or it really depends on your whole tax strategy.
Mark, how about from a tax perspective? Is self-storage considered active business or passive business?
Well, if you ask most people, they'll tell you it's an active business for the tax code. Yeah, I went to ChatGPT, I asked that, and it said that, and then I explained my situation, and they said, oh yeah, there's an opportunity when it can be passive. When you're active, you pay more taxes. The tax, it's like it's like the stock market. I buy stocks. That's passive. I make a profit. I only pay 20%, whatever's left over as a profit. And it's the same thing with self-storage. I have a large accounting firm, and so every once in a while I'll get a new person doing my taxes, and I'll see my taxes go up $100,000, and I'll call them up. What the heck? Why did my taxes go up? And my income didn't really go up that much. And that person doing my taxes checked the box, active. Okay. So you gotta take a look at that, because if I can save that 15% without having other complications and having to do other things, that's very, very, very important. But there's other things you got to look at too, because there's something called QBI deduction, qualified business income. That's 20%, but you have to be an active investor. So there's a lot of combinations going through here. But the problem with, normally I would take active and qualified business income, but qualified business income has income limitations. So, even as a joint filer, I think it starts around 200,000. That 20% goes down at 400,000. It's all gone. So once you make too much money, you don't get that qualified business income. I'd rather get that 20% than say 15%, but at some point it phases out because your income is too high. So you got to look at these types of things when you choose your taxes and do your taxes. But when you first start, you need to ask your tax accountant, hey, is my business a qualified business income deduction? Am I qualified for that? Because indeed you are. You might not be because your personal income is too high, but if it's limited, you will qualify for that. And then you don't have to, work so hard to become a passive owner. In the beginning, it's hard to be a passive owner. There's just too much going on for you to be a passive owner. But unless you turn it over 100% to somebody else, and that normally is not what's happening.
Another big one, Mark, for when owners do sell, when they sell their self-storage facility, the owners often face a big tax bill from the profit. What are some ways to reduce that tax burden from the sale?
Well, the biggest one is, don't forget my second favorite tax advantage. Buy, borrow, and die. Don't sell it. You're going to be sorry. So many people sell all their businesses, and they're 90% of them are sorry. So that's the first way is don't sell it. There's 1031 tax exchanges. People hear about these also. If you change one like property for another property, you don't have to pay the taxes on it. It's easier said than done. There's a time frame. So you have to find that property in a certain time frame. You just don't want to trade for another property that nothing about, that's miles and miles away. That's going to be a headache for you. So it's a difficult one. But you can eliminate those taxes by transferring to a like property, but it's not as simple. So don't assume you're going to do that without some heavy duty review. Another one is when you sell your self-storage. If you build a self-storage, we had one franchisee. He had a partner, and he opened up his self-storage, and it was 6 months later his partner moved out of state. He got so upset that he thought he was doing all the work. So they put it up for sale at 6 months. 30 days later, they had a 6 months open. They sold it for $5 or $6 million more than all their expenses. So, they made a $5 or $6 million profit on paper. I said, you just, I don't even think you should be selling it now. Sell it in a year from now. Instead of getting 5 or 7, you'll get 12. But they had their minds made up. But I said, you're going to pay regular income on this. You're going to be in the 39% tax bracket. If you keep it for a year, you'll pay capital gains of 20%. They did the math, and immediately it was millions of dollars. So they went back to the buyer and said, we can sell you this. It was already 6 months. We can sell it to you for 6 months in a day if you want to sign the deal now. And they actually did. So it's like the stock market. You'd rather pay capital gains than pay regular income taxes. So those are 3 different options right there when you sell. Or you build another self-storage, so you have write-off from that self-storage to cover that profit. So there's actually a 4th one. So that's cool.
Nice. All right, as we're wrapping up here, we're going to get to closing remarks and open it up to Q&A. I wanted to share 3 quick tips as well. It's from a book, Tax-Free Wealth, by Tom Wheelwright. Now, that was the CPA of Robert Kiyosaki, if you guys remember Rich Dad, Poor Dad. So, obviously he had a lot of good insights, but 3 big tips I took away from that. If you want to change your tax, change your facts. Don't wait to tax season. Design your storage business activities to align with tax saving strategies. So that was a big one. Another one was the government wants you to invest in real estate. Tax-free wealth isn't a loophole. It's a reward for building infrastructure, creating jobs and providing services. So take advantage of that. And then the last one, your CPA should be your most valuable advisor, not an historian. So work with a proactive tax professional who plans forward, not one who reacts backwards. So, make sure you have the experts on your team, someone like Heidi. Um, and we'll go ahead and close it out. Heidi, is there anything else you want to share with the audience, before we open it up to Q&A?
Gosh, what a great topic. You guys kind of nailed it with all of those strategies and considerations for tax. So we always offer an upfront proposal and estimate of the deductions that would be realized with a cost segregation study, and we charge a fixed fee price as well. So it's very transparent with understanding the benefit, the costs, and the process. And we can typically work with you also to understand the tax implications over the long haul of your property ownership. So we're here to help and assist, and have always enjoyed working with Marc for quite a few years, and happy to answer any questions.
Awesome.
Heidi, and I want to say, I've known Heidi a long time. Self-storage is one of her expertise, if not her main expertise. We see her at all the shows. So it's somebody you need on your team sooner rather than later. There's other things that she might be aware of. The tax code is complicated. I remember my engineering business, we had a section 179. You could do repairs and this kind of stuff. You could only deduct $20,000. And now, if your furnace goes bad, and it's a $20,000, $30,000 repair in your self-storage, I believe you can deduct that all right now. So there's other tax strategies, solar, and Heidi knows about a lot of them. Even if she doesn't do them all, she does know about a lot of them, and she does do quite a few different things other than just depreciation. So you have an idea that you want to run by somebody, she's somebody you can call. But just to summarize everything, the biggest cash flow is done by what I call tax strategy stacking. Find out what works for you. You're going to use several other you might not, and those are going to change. When you're not making any money, and some wealthy people aren't making any money. They just sold their business, and now they have no income. So they're not making any money. Other people making 100. It's one set of tax rules, and then when you're making 800,000. So with self-storage, you might go through 2 or 3 different, I'll quote, tax seasons where you have different strategy of stacking. Those choices have to be made with your team. That's number 2. Number 3, there are multiple qualifications for most tax strategies, and there's pros and cons. So ask those questions. And number 4, go to ChatGPT and learn a little bit, so you're prepared to talk to your team. When you use ChatGPT, you can't trust it 1 iota, not 1 iota, but it will ask it question after question after question, and then you'll be ready to talk to your tax pro. And it might bring up some reasons why, hey, I don't have the energy to do that. There's a lot of tax savings that I'm too lazy for, and I just don't need to spend extra time. Catch the big ones is where I'm at in life. So that's it. Garrett, I guess we're going to open it up if there's any couple of 1 or 2 questions. We're
Yeah,
here.
no, great information, Marc, Heidi, much appreciated. We'll open it up for a Q&A now. So if anybody wants to unmute, we love hearing from you. If you feel more comfortable putting your question in the chat, we'll hang out for, as long as the questions are coming in. While you're either unmuting or putting your question in, I'll tell you about our next webinar. That's going to be the September 11th, 11 a.m. So second Thursday next month. And we're going to be covering don't look for self-storage land without these AI insider tips. I can tell you this, one of the #1 tips is the human loop. There's too many individuals going down the rabbit hole of, trusting an AI fully. You need a team, you need experience, and we want to bring some of this to light. So we'll be covering that, next webinar, September 11th, 11 a.m. Not seeing any questions coming in.
Garrett, you're going to send this out to everybody and put it on YouTube or wherever.
That's correct. I'll once we get it through YouTube, I'll put it up on our newsroom and I'll send it out to anybody registered as well.
Yeah, and if some of this information was usable to you, you might want to go to our website. It's got a blog on there. A lot of this stuff is repeated on our blogs, different information. You can sign up for our newsletter where just once a month, but we share these type of simple tips one at a time that you can implement and use in your business, or at least gives you food for thought. That's our goal, is just to help you understand the options and the possibility. We love self-storage, so we don't mind a call anytime, and I'm sure the same goes for Heidi.
Absolutely.
Awesome. Thank you everyone for joining. Heidi, appreciate your time, and we'll see you guys on the next one.
Awesome.
All right, take care.